How to do asset allocation and portfolio rebalancing. That's the topic in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
What is the importance of the portfolio rebalancing and asset allocation?
Asset allocation is a very critical thing. Asset allocation is the first step, that you decide what part of your money should be in equity and what part of your money will be in fixed income. This is a crucial step, and there isn't a scientific formula. There isn't a very precise formula to drive it. To specify that people come up with some makeshift or some formula that deduct from 100 your age and that should be your equity allocation and something like that. Don't follow that. But basically, it's a very subjective thing. But having fixed equity gets you return, and equity gets you superior return, but it comes with great volatility. Fixed income provides you stability, and it comes with lower return with greater stability. So mixing your equity and debt provides, depending on how comfortable you are with the, what is your risk tolerance to the ups and downs of the market. If you are fine with it, if you are used to it, and then it can well be 90% equity, 10% debt, and you are comfortable with it, that's okay.
So your risk appetite
risk appetite should govern that. But having it's all easier said than done. Investors' thinking is a very malleable thing. It changes with time. It changes with the market. It changes with the kind of return that you are getting. When the markets are going up, then people say that they have all the risk tolerance. They can tolerate they can withstand any kind of decline.
Yeah.
In a time like this, people are waiting to run away forever and depriving themselves of a great opportunity. So, and markets will remain cyclical. So, it's important for investors to decide on their comfort zone. And this is what we keep telling. When we say balanced fund, we are basically saying that 75% of your money will be in equity, remaining in fixed income.
Okay.
But you don't do the asset allocation yourself. We are providing a fixed income allocation inbuilt in the recommendation or at the advice, so that it does not turn out to be, it's a steadier take on growth. Likewise, but there are people who retire, they invest their money, and they have no need for income from their investment. Still, they will be very uncomfortable if their investment is going up and down dramatically with the market. So, having a 50% allocation to equity, 50% allocation to debt, that does the job. After you have done this asset allocation, rebalancing comes into play. Because markets are cyclical. If you are assuming that you have decided to invest 50% of your money in equity, 50% in debt, which is your asset allocation, this 50% becomes 40% because market has gone down by 10% or 20%. If you would have done it a year ago and it has gone down to 40, and because your fixed income has gone up a little bit, so maybe your fixed income is now about 60% or 62%. And equity is down to 48 or 40 or 38%. That's the time when you should, on an annual basis, you should move your money to fixed income to equity. This effectively means that you are rebalancing it. You are, resetting the allocation once again at a defined periodicity, but not very frequently. Because if you do it very often, it will have tax consequence. It will have serious tax implication. You'll be quickly, moving back and forth on some asset or the other, selling some, buying something. It can all be done another way. If you are in your asset allocation, if you are in your accumulation phase, if you are, doing your investments even now on a regular basis, then to rebalance, investing your new money, incremental money in the asset which has gone down, that actually works that turns out to be more tax efficient. So you can actually reset the allocation with new investment being made into the asset which has fallen from your target asset allocation. So this is a nice way of buying low and selling high, or not selling something when it is at its low, but investing more in that, and in a methodical way. You follow it in a programmed manner, and this eliminates your emotional bias, because most of the time we do the opposite. When we are scared, then we don't invest, and that might be the good time to invest. And when we are when easy market is going up nicely, quickly. So we just invest without thinking too much about it. So, and that is actually takes your allocation in a unusually risky zone.
Okay, so how do you rebalance your portfolio? Do you set an allocation range? What do you do?
I would say that investors should keep it very simple. If you have decided on a 50% allocation to equity and debt, do nothing if it changes by 10%.
Okay.
Because if it becomes 55 and 45, don't do anything. The moment it crosses that, take some action. Sell a part of the one which has gone up and move it to the other one, so that the combined value is split equally into both.
Okay.
I think 50% allocation actually gives you greater opportunity to rebalance it with simplicity. And I think over time this activity itself can enhance your return, because you end up buying low and selling high, even because in case of SIP you are averaging your investment, but in case of your accumulated investment, you see your investment crumbling and you do nothing about it, or you see your investment go up dramatically up and you do nothing about it, and then the market slips. So by doing the rebalancing, you will be able to lock in your profit. You will also be able to invest when markets are at its low.
For a regular investor, which most of us would be, do I need to take help from the manager? Do I need to take somebody's help, or should I do it on my own?
If you have been taking help, then you should be demanding this help, because if somebody is helping you invest and he is not providing you this advice or suggestion, then you should demand this help. It can also be embedded in your fund selection, because when you invest in an equity fund, then you are choosing to invest all your money into equity. When you invest in a balanced fund, you are choosing to invest 70% into equity, 30% into debt. You don't have to do the rebalancing yourself. The fund manager will do it, and he will do it in a more tax efficient manner. And your experience of investment will be the same in terms of greater stability than an all equity investment. Likewise, the equity income fund, which is a third of it in fixed equity, remaining at 2/3 in fixed income, that is a very conservative take on growth. So that is another thing where it has embedded asset allocation. The fund manager is supposed to keep that allocation intact. So you can do it with simplicity, you can demand this, or if you're doing it yourself, then make sure that you are doing it with fewer funds, so that implementing this strategy, implementing this plan, it can be done with 2 funds, 1 equity, 1 debt. It can be done with 2 equity, 2 debt. And that's all that it requires. And looking at the investment performance or investment's worth once in a year will do the job. Don't be hyperactive about it. If you try and do too much, over engineering, it'll hurt you.
Okay. For tax efficiency, shouldn't we be considering the hybrid funds?
Yes, hybrid funds turn out to be far more tax efficient, because whenever you take these actions, you are liable for the taxes for all the realized gains and all the realized losses. Okay. You get the credit for all the realized losses. When it happens underneath the fund, when you invest in a balanced fund and the fund manager is buying and selling something to retain the allocation at 70/30, or a equity income fund or a balanced fund at 50/50, you are not liable for any taxes. It is happening at the fund, so you are deriving the benefit without liable for the taxes. So this is a more tax efficient way of doing it. But many a times, investors would like to have a greater control. Also, the tax efficiency actually kicks in once your investments are 3-4 year old. Then doing yourself may not be very tax efficient. Earlier, the tax efficiency was far higher in these hybrids, because equity was not liable for any tax. It was completely exempt for tax, from taxes if held for over 1 year. There was no long-term capital gains. Now there is one. Likewise, in case of fixed income, after 3 years, it is treated as a capital. It's considered as a capital asset, indexed and gains. So once your portfolio becomes 3-4 year old, even doing it yourself may not have a serious tax implication.
Okay. So should one be more taking more risks, or should one be aggressive? Should one be conservative? So what is the appropriate asset allocation?
Depends. If you're a first timer, be conservative, because it's important to develop a belief. It's like testing the water. Don't experience something in a manner that it scares you out forever. It drives you out forever. So that's first aspect. Second is that if you have experienced the market for 2-3 years, you have understood its cyclicality, you have understood, and you have also experienced the gains, then you will be able to appreciate it better. Then I think, but primary thing is, I think two things which matters most, and I don't think any expert can answer that, because that is very much your viewpoint, which is very much unique to every investor. One is that how experienced you are. Depending on if somebody has been investing in the market for 5-7 years, he'll be more comfortable with the declines and the gains, or he will not get exuberant about what's going on. He'll not be scared, or he will not get as excited with the gains as a new investor will be. So one is experience. The other is how critical is that money. If you in all you have been able to accumulate 8 lakh rupees, and that 8 lakh rupee, very important things depend on that. So depending on your needs, you will attach greater anxiety to that investment. If that, and if you have accumulated 50 lakh rupees, and you have some other assets, you have a nice cash flow, you have a great income, it is one of the thing, and you are still, and the time frame that you have, you are unlikely to need the money for another 10-15 years. You will be in a completely different frame of mind. If you are likely to need this money in 3 years' time, then you will have worry, and rightly so. So these are things which govern it. These are things, so depending on the time frame, depending on how comfortable you are, and depending on the scale of money, I think most investors will do a good job by, having a 50% to equity, 50% to debt, and active rebalancing. That will do well for them. If this is the critical money which you are likely to need in a time frame of 5 to 10 years. If it is even longer, it is one of the secondary asset which you are accumulating. It is not the primary, it's not all that you have. You still have 10, 15, 20 years. Maybe you can go up to 75% equity, 25% into debt, maybe through a balanced fund. If you are a venturesome person, and you find that you want to realize great gains over the next 10 years, maybe 90% equity, 10% debt. So it entirely depends on these circumstances, which is very difficult to quantify, or an external expert to provide any opinion on. You are your own best judge.
Okay. So you heard how to do asset allocation and portfolio rebalancing, and once a year.
Annual, yes.
Annually, you need to do that. Okay, we now move on to the Q&A part of our program, where we answer the queries sent by you. Okay, we have our first question from Shirish Joshi, who says that I am 50 years old and plan to retire in the next 8 years. What should be my asset allocation? Kindly help me articulate the right strategy.
Insufficient information. Because it entirely depends on
how much he wants to invest and all that.
No, one is that, whether he will need income from his investment, or if it is going to be a primary income from his investment, or if it is going to be a secondary income from his investment. If he's in a government job and he will retire and he'll start getting his pension, and he wants supplementary income after he retires from this investment, and that too not at regular periodicity, every 6 months he will get some money, he'll be happy with it. And the primary job of, primary role of this investment accumulation is that it should grow well over a period of time, then it requires a different plan. So I would say that if you're looking for investment, 8 years from now, you have enough time. You can well be, 75% equity, 25% debt. If you're going to require income from your investment 8 years from now, still you will require equity in substantial way. But that substantial is entirely a function of whether it is going to be primary or secondary, supplementary income. If it is primary, then you have to work around a 6% withdrawal rate from such investment. And that, I think, will make sure that, your investment grows. At the same time, you are able to derive this income, and that 6% can get updated, can get revised every few years depending on the appreciation.
Okay. Mithun writes in saying that within equity mutual funds, what should be the bifurcation between large, mid and small cap?
This again is a very subjective thing, but I would say that going by the way large, mid and small is classified, now they are formally classified by the regulator. Yeah. That is a similar thing which we used to follow in our classification system. So I think large cap should be about 50 to 70%, mid cap should be 20 to 40%, and small cap should be 10 to 20%, because that is and that is also the complexion of the market. The whole idea should be to get a full exposure to different segments of the market, which you'll be able to derive with this kind of allocation.
Okay. Is it fine to put all my debt allocation in 2 to 3 ultra short term funds, or should I diversify on the category level? And this is from Shubham Garg.
Yeah, I think it should be okay to diversify, in 2 ultra short-term bond fund, or maybe at most, 1 or 2.
What about the category level?
In this category itself, okay. Because there are 13 kind of debt funds. Last time we were talking about that gilt fund, which turns out to. So there are many categories of debt fund, which is not, which is not understood by investors, or it is not suited for investors, or sometimes they look good, but it might be inappropriate for them. So ultra short-term bond fund and short-term bond fund turn out to be the most predictable, safer, or one more category in terms of fixed income fund that is good enough. So you will not be deprived of anything in terms of predictability if you are investing in 2 to 3 ultra short-term bond fund.
Amit has written in saying, how can one choose or differentiate between 2 funds in the same category giving similar returns?
Giving similar returns, look at the down phase of the market and up phase of the market. There are funds which can give you, say for example, 2 funds giving 15% annualized return over the last 6 years. One would have derived most of its return in a rising market and would have lost reasonably in a falling market, and still this is the return. The other one could have done the opposite. They could have, the fund may not have gone up dramatically, but it would have withstood the decline much better. And depending on what you are comfortable with. Then the second thing which I will look at, that is the same fund manager managing the money. If there isn't a change, worry about it. And if both are same, so choose one of the 2.
Okay. I want to generate regular income for my remaining life, and at the same time I want my corpus to grow. In such a scenario, what should be the withdrawal rate through SWP? Will 1% per month be ideal? And this is from Praveen Godbole.
No, 1% per month will be dangerous. You will run the risk of eating your capital much ahead, because 12% return predictable. It might 1% return 4 or 5 years from now might be possible, but by that time your capital would have also gone up. So in the initial years, if you have been able to save so much that you require 12% per annum from that investment in a reasonably predictable fashion, you run the risk of consuming your capital, and you run the risk of outliving your savings, which could be a very dangerous situation to be in. Or not a very comfortable spot to be in. So I would say that a reasonably okay allocation, your withdrawal rate should be 6%, and maybe in 3-4 years time frame you will be able to build the residual capital, because in this investment strategy is nothing but leaving something in your capital of your gains.
Correct.
Remaining invested. You don't consume all your gains, so that in future you are able to enhance your income.
Okay.
So 1%, no, it's 0.5% to begin with, and maybe 3-4 years time you will get an opportunity whereby it'll look like 1% of the original investment.
So 6% per annum is what the range is.
Yes.
Okay. Mukesh writes, almost everyone suggests in investing in mutual funds with a long-term perspective, but no one talks about the right time to exit your investment from them. So what is the best time to redeem your investments from there?
No, first and foremost, we say that invest for the long term, but then you need the money whereby the time frame is no longer long term. You have been investing and now you have come closer to your goal and now you need the money in 2 years time frame, 2 years from now, then methodically unwind. You are doing your systematic investment plan and then you start your systematic withdrawal plan. So one is it has nothing to do with this market. The second reason when you should sell is you did choose a good fund and that is no longer a good fund. Then sell your investment. Third is that your circumstances change. You invested with a 10-year time frame, but somehow your circumstances have changed in a manner that you can no longer be a long-term investor. You are likely to consume this money or needing this money in 3 years time frame. Then start unwinding. One critical thing is that we keep suggesting average your investment. Likewise, average your withdrawal, so that you are able to prevent yourself from depending on the market when you need the money. Don't bank on the market in the short run, which is the idea behind doing, why you should be doing your SIP. That exactly the converse of that is that don't depend on the market when you need the money. Be methodical about it, even if it translates into some opportunity losses, so be it.
Praveen Shukla has written in saying that I had invested some money in mutual funds through an agent but have lost the contact with him. I want to now withdraw my investment. How can I do that?
2-3 ways of doing it. One is that you can still look for the agent. You go to amphiindia.com and type his name, and there is a lookup of all the mutual fund agents there. They have an ARN number and you will be able to look up for him. You can also figure out in your account statement itself will be his ARN number, and you can find your agent and his phone number at amphiindia.com, which will be there, mentioned there in your account statement. Second is that if you have the account statement, all mutual fund account statement comes with 2 counterfoils at the bottom. One is for investing more and the other is for redeeming your investment. So just fill the other part, which is redeeming your investment, and you can choose. You can redeem part of it, you can redeem all your investment, you can redeem in terms of units, in terms of rupees, you can choose to, and you don't have to fill too much. You just have to sign and say that how much money you want back, or you want all your money back, and send it to the fund company and it will get executed. In case of mutual fund, because you provide your bank account while you are investing, and the proceeds can come back directly in your bank account, can come only in your bank account. So you don't have to do anything. You just have to file your redemption request and you get your money back.
It's quite simple though.
It's straightforward, yeah.
Okay. Pulkit Soni has written in, though you have been advising us to use multi-cap funds for simplicity, can you please also explain the importance of having mid-term and mid and small cap funds in a 20-year portfolio? What should be their weightage?
It's a tricky question. But yes, mid cap and small, on a 10-year basis, the difference between a large cap fund and a mid cap fund and a small cap fund could be 1 or 2%. It's not going to make a material difference. Of course, on these periods, it is difference. It is an amount of money, but it is not dramatically different. It is not that large caps barely give you some return and mid caps give you some dramatic return. It isn't like that. Looking at these returns, the cyclicality of the market catches up. The small caps, 2 years back, small cap returns were looking much more handsome than the large caps. And then the market complexion changed. Large caps actually surged, small caps declined, or they fell so dramatically. And now we find that the difference is not that much, 10-year, 15-year return. And that is what will happen over the next 20 years. There will be a phase when small caps will do very well. There will be a phase when small caps will struggle and large caps will do well. But there will be a difference. But mid caps and small caps also cause great deal of heartburn. When they fall very freely, and that is very unnerving. So if you're okay with this, if you're comfortable with what is happening to small caps and mid caps today, and you still are brave enough and have the courage to invest, then go ahead and invest. It can well be 40-50%. You have to choose the mid cap and small caps a little carefully, and also you have to keep an eye on it to make changes every 2-3 years. Large caps, many of them actually look alike. Also, the difference between a large cap and choosing an index fund, there won't be a great deal of difference. In case of small cap, the great small cap fund and the not so great small cap fund, the difference will be huge. So you have to be a little more active in choosing your small cap and mid cap funds.
Well, that's all we have in today's Investors Hangout. Dhiren, thank you so much for answering the queries of our viewers. And I hope and pray that you have paid good attention to the asset allocation and portfolio rebalancing that Dhiren explained to you. Till we meet next time, it's goodbye from Dhiren and Rajesh.